Hey everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week I'm going to break down what's happening in real estate, mortgage rates, and the economy, just how you consume it best. So if you're somebody who really just doesn't care how the clock's built and you just want to know what time it is, the next minute or so, it's probably for you. Now, if you like to know how the clock works, stick around a little bit longer. And for my friends that really like to know how to build the clock, I've got a little bit of a deep dive towards the end. So let's go ahead and get started for my friends that just want to know what time it is. So, lower mortgage rates, well, they're actually starting to move the needle a little bit. And here's where rates actually stand right now based on national averages from Mortgage News Daily. The 30-year conventional rate, it's around 6.07. The 30-year FHA is around 5.75, and the 30-year VA is around 5.77%. Now, remember, these are national averages. They're not necessarily your personal rate. Your rate could be higher or lower depending on your credit, the equity, your loan type, and the overall strategy. But directionally, where rates are right now, they really matter. And we're already seeing that show up in housing data. Existing home sales actually jumped 5.1% in December, and that marked the fourth straight month of increases and the strongest pace that we've seen in almost 3 years. Now, new home contracts are also sitting near 3-year highs, which tells us that buyers are slowly coming back in as rates ease. But supply, well, it's still the problem. We've got plenty of homes that are under construction, but far fewer that are actually completed or move-in ready. And that supply imbalance, well, it's why prices are staying supported even as activity improves. Now, on the inflation front, December data came in right in line with expectations. Headline inflation is running about 2.7%, and core inflation is about 2.6%, and wage growth looks like it's starting to slow. Now, the Atlanta Fed wage tracker shows that wages, they're rising about 3.7% year over year, and that does help take pressure off of inflation and support lower mortgage rates over time. And despite the scary headline that you might be seeing from the YouTube fearmongers about the bubble burst, well, foreclosures remain extremely slow. They're at about 0.26% of all homes nationwide. Now, that's nowhere near anything resembling a housing crisis. So, the bottom line for my friends who just want to know what time it is, well, rates are improving, housing is stabilizing, and waiting for a big crash to drop mortgage rates, that would mean you'd probably be missing a pretty big opportunity. Now, let's go ahead and talk about how the clock works. Now, mortgage rates, they don't need to be low to change behavior. They just need to be lower than they were. And as rates eased, buyers who had been sitting on the sidelines, they started re-engaging. And that's why we're seeing sales activity improve, even though rates are still well above pandemic levels. But supply, it just hasn't caught up, and it can't catch up quickly. Builders don't move at the speed of mortgage rates or headlines. They move at the speed of permits, labor, materials, inspections, well, and time. And that's why sales can rise without prices falling. Now, you may have seen stories claiming that foreclosure activity is surging, especially among FHA borrowers. And yes, foreclosures did increase year over year, but from extremely low levels. Now, even now, foreclosures represent just 0.25% of all homes. And that's normalization, everybody. That's not distress. Now, the labor market, it tells a similar story. Wage growth, it's slowing for both job stayers and job switchers. And that signals cooling, not collapse. And it's exactly what the bond market actually wants to see. So speaking of the bond market, mortgage-backed securities, they're actually holding key support levels. And the 10-year Treasury, it remains below that critical 4.2% ceiling. And as long as both of those levels hold, patience is going to remain the main strategy. Now, for my friends that really want to know how the clock's built, one of the biggest misconceptions right now is the belief that lower mortgage rates automatically mean home prices are going to fall. Now, to folks that don't watch the market every day, that might sound logical, but historically, it's just not how housing behaves. Housing prices don't move on headlines. They move on supply, demand, well, and access to credit. When rates are high, affordability tightens. Buyers kind of pull back. Activity slows and price growth cools. But when rates start to fall, even modestly, demand, it wakes up faster than supply can actually respond. And that's exactly what we're seeing right now. Inventory doesn't surge when rates fall, competition does. And that's why housing corrections tend to happen when rates rise quickly, not when they ease. Now, context matters here too. Over recorded history, the average 30-year fixed mortgage rate, it's somewhere around 7 to 8%. Now that means that low 6% rates that we're seeing today, they're not historically high. They just feel that way compared to the emergency level rates that we saw a few years ago. Now, those were the exception, not the rule. Now let's talk about what's actually causing housing crashes. You don't get housing crashes without forced selling. And forced selling happens when people lose jobs in large numbers. They can't make their payments or they owe more than their home's actually worth. We don't have those conditions today. Unemployment remains historically low, homeowner equity is extremely strong, and while wage growth is slowing, it's not collapsing. In fact, the wage slowdown, it's actually part of what helps inflation continue to moderate. Slower wage growth leads to slower spending. Slower spending cools inflation, and cooler inflation puts downward pressure on interest rates. That's the same progression we talked about last week. In the bond market, it actually continues to confirm it. So where could rates go from here? Well, most forecasts, they don't ever point to a magic number. They point to a range. And in a very optimistic soft landing scenario, I think we could see 30-year conventional mortgage rates drift into the mid to high fives, with government loans actually being in the low to mid fives. Now, the best case expectation for a lot of economists is that we're going to see low to mid 6% range for conventional loans and mid to high fives for government loans. Now, in a higher rate risk scenario, if inflation reaccelerates, rates could move back into the high sixes or even the low sevens. Now, that said, most forecasts still suggest that rates could touch the mid to high fives at some point this year. And if last year has taught us really anything, it's that lower rate windows, they don't stick around long. The last few big dips that we saw that got conventional loans under the 6% mark, well, they lasted for about a day or two before bouncing right back where they were. Now, that's why working with a seasoned, educated mortgage professional matters. Somebody who understands how the market moves and can help you act quickly when the opportunity shows up. That's also why strategy matters more than predictions. So the people who win in this market, they're not trying to time the perfect rate. They're actually positioning themselves early so that they can optimize their buying potential and act when the opportunity shows up. Rates fall, buyers return. Competition increases, prices stabilize or rise, and affordability tightens again. That's how the clock's built. So hey, if you're thinking about buying, refinancing, or you just want help understanding how these numbers apply to your specific situation, reach out anytime. I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and I'll see you next week on 1 Minute Monday.